Hello everyone, and thanks for watching Edupedia Word videos. In this chapter, we are going to talk about the equilibrium. For that, we are going to talk about the equilibrium in both money market and foreign exchange market. Then we are going to have a look at the maths. So let's get started. Well, equilibrium in the money market is where the demand for money, L, is equal to the supply of money, MS. This equilibrium is achieved through changes in the rate of interest. Well, in this figure, equilibrium is achieved with a rate of interest, RE, and a quantity of money, ME. If the rate of interest were above RE, people would have money balances surplus to their needs. They would use these to buy shares, bonds, and other assets. This would drive up the price of these assets and drive down the rate of interest. As the rate of interest fell, so there would be a contraction of the money supply, a movement down along the MS curve, and an increase in the demand for money balances, especially speculative balances, a movement down along the liquidity preference curve. The interest rate would go on falling until it reached RE, so equilibrium would then be achieved. Similarly, if the rate of interest were below RE, people would have insufficient money balances. They would sell securities, thus lowering their prices and raising the rate of interest until it reached RE. A shift in either the MS or the L curve will lead to a new equilibrium quantity of money and rate of interest at the new intersection of the curves. For example, a rise in the supply of money will cause the rate of interest to fall. In practice, there is no one single rate of interest. Different assets have different rates of interest. This table gives examples of the rates of interest on various assets in the United Kingdom in September 2007 and September 2011. In fact, equilibrium in the money markets, therefore, will be where demand and supply of each type of financial asset separately balance. If, for example, there were excess demand for short-term loans, such as 1 month interest lending, and excess supply of money to invest in long-term assets, such as bonds, short-term rates of interest would rise relative to long-term rates. Generally, however, different interest rates tend to move roughly together as the overall demand for money and other liquid assets or their supply changes. Thus, interest rates may generally rise or generally fall. Now, let's talk about the equilibrium in the foreign exchange market. Changes in the money supply also affect the foreign exchange market. In a free foreign exchange market, equilibrium will be achieved by changes in the exchange rate. Assume that the money supply increases. This has 3 direct effects. Part of the excess money balances will be used to purchase foreign assets. This will therefore lead to an increase in the supply of domestic currency coming on to the foreign exchange markets. The excess supply of money in the domestic money market will push down the rate of interest. This will reduce the return on domestic assets below that on foreign assets. This, like the first effect, will lead to an increased demand for foreign assets and thus an increased supply of the domestic currency on the foreign exchange market. It will also reduce the demand for domestic assets by those outside the country and thus reduce the demand for the domestic currency. Speculators will anticipate that the higher supply of the domestic currency will cause the exchange rate to depreciate. They will therefore sell domestic currency and buy foreign currencies before the expected depreciation takes place. The effect of all three is to cause the exchange rate to depreciate. Let's have a look at the maths. Equilibrium in the money market is where demand and supply of money are equal. The money supply MS equals the monetary base MB multiplied by the money multiplier, as you can see. Note that this is the more complex version of the money multiplier that we examined, not the simple bank deposits multiplier developed in the previous video. From the looking at the mass, the demand for money L is given by this equation. Thus, in equilibrium, MS equal L. At first sight, this equation looks quite daunting, but what we have done is to bring together money supply and demand, each of which has been separately derived in a set of simple stages in one single equation. Equation number 1, we have completed a jigsaw made up of several simple parts. So, as you can see, this video is very short, and let's summarize. We saw that equilibrium in the money market is where the supply of money is equal to the demand. Equilibrium will be achieved through changes in the rate of interest. A rise in money supply causes money supply to exceed money demand. This causes interest rates to fall and a movement down along both the supply of money curve and the demand for money curve until money supply is equal to money demand. Eventually, equilibrium in the foreign exchange market is where the demand and supply of the currency are equal. A rise in money supply causes interest rates to fall. The rise in money supply plus the fall in interest rates causes an increased supply of domestic currency to come onto the foreign exchange market and a reduced demand for the domestic currency. This causes the exchange rate to depreciate. So this is the end of this video. The next part will be related to consumer awareness. Thank you very much for your attention.